Hello and welcome to another episode of Multifamily Strategy. I'm Christian, joined again by Caleb Hommel, the one and only.
How are we doing?
Welcome back to the channel, man.
Thanks for having me.
Today we're talking creative finance terms. If you're trying to get creative terms, how do you negotiate it with the seller? How do you get seller financing the way that you need it to make your deal work? We're talking about the specific terms. How do you know you have the right terms? How do you negotiate them? How do you get the yes? I see a lot of people online get stuck on this problem. We're going to solve this problem today.
Let's do it.
I saw seller financing online, but they want 50, 60, 70% down. Or, yeah, they're willing to seller finance, but they're willing to do it for 2 years. If all your value is in the terms and your terms only last 2 years, you haven't created a whole lot of value.
Amen.
We're going to show you how to fix that today on this episode. If you haven't yet, please like and subscribe to the channel. We talk about creative finance, real estate, operations, the whole 9 yards. We are operators in the field showing you guys how to play the game. We appreciate your support of the channel. Caleb, when we're getting terms, you have called more brokers than anyone I've known. Like, you called to get your first deal.
Just a few.
I'm going to set the stage here. This is important. How many calls do you think you made to get your first deal?
1,500 and 2,000 probably.
That seems about accurate. And guys, he kept this immaculate, massive spreadsheet for every broker.
Thank God I don't use it anymore.
When you did that, you did eventually get low down seller finance deals, right?
I did.
And it took you about, again, 1,500 to 2,000 calls.
Just a few.
It takes a lot of time to do that. How many deals did you look at, roughly? Best guess. That were like either like maybe we'll seller finance, but it's going to be a high down payment or the terms aren't going to work. Like, how many was it on the table, but the terms didn't?
Probably at least 300 to 500 of them, to be honest. Like total deals and seller finance that actually had a chance of working. I'd say probably 50. And like Christian was talking about, the big misconception is you need all of this down payment. You don't need that at all. These people that are trying to sell you that probably don't actually understand the game they're talking about. More than likely, they're talking about a wrap and they're trying to tell you how to actually do it, or they're trying to sell you on a pipe dream on a deal that's going to fail that they can just take back afterwards.
Oh, and that's actually bringing up a really good point. I didn't even think of that. Yeah, a lot of people who actually offer seller financing aren't in a position to actually seller finance. So you can seller finance anything that you own. If you still have debt on it, then yeah, you can try to pass that debt. You can do a wrap subject to. And those carry inherent risk. We avoid those because they create callable notes. We do not build financial freedom on a foundation of callable notes. You don't have control of your freedom. That's not really freedom.
Yeah, I mean, at the same time, it's like Christian talked about, the foundation is everything. And don't get me wrong, I'm not against wraps on everything. If it's a car, I'm actually trying to do that right now. I'm all for that. Like, I think that's awesome. On a commercial piece of property, you're flirting with trouble there. Those notes are callable. Banks audit those consistently because it's usually $1 million or more. That's a lot different than a $15,000 car loan.
It absolutely is. And I think that's a lot of discipline from a very young investor, 21, to say, hey, wait a second, I understand the correct use of this type of creative finance, and it's not to build financial freedom. Now, if you're already rich, you're already financially free, and you want to mess around with subject to and other clauses like that, go for it. But don't build your foundation on something that is less than solid, which is what we talk about there. So you have a bunch of deals that aren't really seller financing.
Exactly.
You have stuff that's high down payment. I have found, and this is the magic of the strategy that I think we've stumbled on and what Caleb's converted to. People will give preferable terms to people they know, like, and trust. All this is saying is that if you are an outsider in your market, you don't have access to the deals that sell off market. You don't have access to the people. They don't know who you are. Why would I lend you money? Which is essentially what they're doing. They're saying, I have this asset. I will lend to you to buy the asset from me. And a lot of times they're selling it. They don't want it back. They're trying to move on. They're going to do that to someone that they trust. Quick example, I seller financed my property management company this year. My Washington State one. We have Apex Asset Management down here in Texas.
This was actually the Washington State Management Company. I'm actually wearing the shirt.
Oh, there you go. Yeah. Kencho Property Management. I don't own that anymore. I have seen remarkable improvements to certain areas of the company by selling to the right person who had the right infrastructure. I built a fantastic company and I sold it to someone who could take it to the next level. And they're actually helping me add some systems to our company down here. I seller finance to them because I know, like, and trust them. I do not want to, I live in Texas now. I don't want to take the company back. I don't want them to fail. I want them to pay me what they owe me. And to do that, they need to be successful in the business. I would not have offered the terms that I offered him if I didn't already know him. It is someone who I've worked with before. I've known for years. The offer made sense for me. And guess what I did? I offered it to him for $50,000 less than I had listed it for. I would not have brought the price down, except I wanted them to be the buyer specifically. The same concept applies to real estate as buying a business. If they don't want the building back, if they want a successful transaction, they want to have the most qualified borrower for seller financing. And if they don't know you, you're probably not going to see low down payments. You're probably not going to see long-term debt. And that's what you need to buy real estate. Caleb, you came to Stephenville, Texas for deal number 4. This is after you've already made your 2,000 whatever phone calls to brokers. You've looked at hundreds and hundreds and hundreds of deals. You closed on only 3. What changed going into Stephenville, Texas?
And first, just want to caveat that Christian mentioned probably. They're probably not going to give you this stuff. That is not an absolutely. I gotten that in 3 deals. And then also talking about too, they don't want the property back. I have a property where I've tried to renegotiate some stuff. Be like, hey, this didn't actually go 100% as planned. They don't want it back. That is the entire thing. The seller does not want it back. Christian's the same thing. An older property owner getting out of the game is the same exact way. They do not want the asset back. They are trying to exit. And then like Christian just talked about, what changed? I made all these phone calls, did all these different things, and then I flipped when I got to Stephenville. For me, honestly, it was as simple as I saw the market where it was going. If deal volume is down 70 to 80%, turns out brokers probably aren't going to have the deals. It was that simple in my head. And that kind of pushed me into following the strategy of relationships even more. And everything's changed. The first deal I did in Stephenville would never have gotten that in a million years without that relationship. And that has blossomed into so much more. Getting involved in the community there, finding access to other deals I'd never heard of, other private money lenders, all that stuff. Deal number 2 in Stephenville. Very similar situation, except it was a relationship with the property manager. And it was a relationship with her that allowed me to scoop up the deal. It was actually talking about another one of the properties she managed. And she's like, hey, actually, I have another deal to sell. Do you want to take a look at it? And it was like, yes, we do.
Yes, we would.
And so it's all a relationship game. And when you build these relationships, you get access to other opportunities people probably wouldn't. I know you mentioned it was kind of a certainty thing. I think it's more of a probably because I still got 10% down on 3 assets. It's more likely than not going to be that way for you, though.
So the next thing I'm going to talk about is the analysis of the deal. But before we transition, I just wanted to point out, Caleb went from making thousands of calls and hundreds of deals realistically today. And I actually don't know the answer to this. This is a legitimate question.
Yeah, we don't.
How many calls do you think that you make on a monthly basis now for acquisition of real estate?
To new brokers or existing?
Overall, like total calls that you are making as opposed to the thousands you were making before. What do you realistically think you do in a week or a month today?
That's a great question. I think it's probably under 50 for the month, if I had to completely guess. And those 50 include follow-ups on existing deals I'm underwriting. This is not every new opportunity. If we're not talking new opportunities, it's probably 12 or less, to be quite honest with you. There's one broker there's a few actually I talk to very consistently that have deal flow that I'm actively looking at their projects. That probably makes up 40 of the calls, at least. The other 10, actually, it probably makes up. The other 10 might be to people in Stephenville, Waco, Weatherford that I'm talking to about their assets. It might even be 30, to be honest with you. It's not a lot. The whole example here is instead of 2,000 calls, it's like 50 a month, but it's follow-up calls, new calls. It's like 15, maybe.
And have you seen, compared to your first 3 deals, the last 2 deals under this strategy, have you seen better or worse deal? Like, are they apples to apples about the same? Are they actually deals that were better than the ones that you took all the calls? Talking about actual like deal quality and execution, which deals were better?
The last 2, and it's not even close. Good tee up there as well. The last 2, just relationship wise, would never have gotten a 26 unit building for $1.6 million on the market anywhere near Stephenville, Texas, unless it's falling apart with no roof. It's an absolute steal on price. The other one, you aren't going to get 3.5% interest only on talking about negative amortization schedule going up to 5% as well. You aren't going to get that kind of deal going for an on-market deal. The seller, even though they might understand it, it's going to look at you as like, okay, this is some random person. Why the heck would I trust them with this? When you have a relationship, it's like, hey, I know you want this certain number on interest rate. I can't get it to you day one, but here's how I'm going to get it to you.
Now, if you guys want to learn more about exactly how Caleb went from 0 units, $300 to where he's at today, or how I went from $5,000 to multimillionaire with 225 units today.
And a kid.
Who's financed, he's paid for by the real estate, which is fantastic.
Come on.
If you want to learn how to do this, I actually put a free video. The link is below in the description. Go ahead and give that a click. That is my gift to you for actually going through and watching this video to this point. That is free. You can register, watch that video. I started with basically no money. You started with less money than I started with. Is a free video for you, whatever starting point you're at. If you have no money, awesome. Real estate is for you. Creative finance is for you. If you have a ton of money, If you want to buy more real estate than the money you have, creative finance is for you as well. Now, let's talk about how so this is how we find the deals. This is how we stack the deck in our favor to actually get our terms accepted. What are the rules of engagement? We talk about it all the time on this channel. If you're new, welcome. I bought hundreds of rentals. Caleb's about to be over 100 rentals. We've been playing this game for a little while. When you are trying to stack the deck in your favor, you become an outsider and move to an insider. What do you actually need now that you have the opportunities? Long-term, cash flowing, fixed rate debt. These relationships open up long-term. And the other big thing they open up is a lower down payment. If you have to raise less money and you start with no money, your deal's astronomically easier. I've done a zero down seller finance deal. Caleb's done very low down seller finance deals. What is your lowest down payment? 10%?
Yeah, lowest down payment is 10%, and kind of caveating off that point of the low down payments. And that's exactly what these relationships open up, like Christian mentioned. There are people out there who are these capital, they're almost like institutional level people, and they're buying huge complexes, multi-hundred units. They've got 6,000 units, yada, yada, yada. They're putting a ton of money down on these things. They're not getting even 80% LTV, probably not 70, it's probably 65. It's a lot harder to multiply 35% down than it is to multiply 10% down. And this is another key aspect of playing the game at a high level, is knowing simple math that it's easier to multiply 10 times 3 than it is 35 times 3 and giving an investor a return and actually still making money yourself.
Absolutely agree. 100,000% agree. We want long-term cash flowing fixed rate debt. The reason we want this is because every time you buy a deal, your income goes up for a long period of time. That helps you set a base. That's how you don't lose real estate. If you're buying deals for appreciation, first of all, that you're never going to hit appreciation if you're not cash flowing. You will lose the deal before you get there.
Unless you're a very high income earner, then you have a shot. But still, let's not do that model.
Let's assume that you want to buy more real estate than your income can support. My first few deals, 2 duplexes, if all my tenants moved out, I could have afforded those mortgages. I was making enough in my career to do that. When I bought a 38-plex on top of those, there is no universe in which I could have supported all of the mortgages had all the properties gone wrong. You hit a point where your real estate outscales your earnings, and the only way to survive that is to have properties where the real estate buys the real estate. And that is your goal. You get the terms accepted by the trust and the relationships that you built. Then you have to go, okay, well, what do I really need? You need to understand some basic math. I recently did a video on loan factor rate. I'm actually going to link it below in the description. You can look at that as well. But a loan factor rate in its essence is your true cost of capital represented as a percentage. The math is super easy. Again, video linked below on exactly how to do that. And then you compare that to the cap rate of the deal. That is the yield on every dollar invested into this deal, the cash on cash return if you bought the deal in cash. And if you are borrowing at a cost of capital, so we're not just the interest rate, we're talking interest plus principal divided by the loan amount. So your entire cost of capital, if it is lower than the yield on your capital, if your borrowed capital makes more money than it costs, you're going to consistently buy deals that cash flow. The math is super easy. Now, once you've negotiated, okay, this is the interest rate I need, and you can choose your interest rate in seller finance and creative finance. I got my terms. I'm going to ask for as long as I can get. 10 years is the start of long-term fixed rate debt, by the way. If you have a 2-year project before you're going to refi, ask for at least 5. That's a medium debt product on your path to get into long-term debt. But you need to come up with a plan of how am I going to buy this and how am I going to never lose it? And if you can do that on every single deal, and every deal pays you from day one all the way through, your income will continue to go up. That is exactly how I ended up here. My wife's retired from teaching. I'm retired from selling for the CoStar Group. My son is completely paid for by my real estate, as is my house. I moved from Washington State and some craziness that I didn't agree with in that state to Texas, which is a better fit for me. Warmer climate, better people, much more business friendly. I was able to do this in under 4 years under this model. And that's the only thing I changed is like, okay, let's just do the math on what deals can we buy in our relationships that we have, where we're continuing expanding relationships and opportunities and only closing on things that pay us from the day we close into eternity. The fun thing is, now for you appreciation people, hold any piece of real estate indefinitely, you will appreciate. You will become wealthy. It is a matter of time. Buy for appreciation based on cash flow. That's what you're trying to get. And you will only get the opportunities that you were looking for, in my opinion, if you have relationships in that market. Because every great deal, if it's a truly great deal, why would they ever list it? They're going to sell it to someone. They're going to sell it to someone who they know. It's an insider game. It's a tight-knit community. That's how you play the game, 100%.
Even if we're talking at the highest levels, one of the mentors that I've started working with more where I'm at currently was looking at a 492 unit complex.
That's huge.
He had a better offer than the person who won the offer, but the person who actually got the deal had a 35-year relationship with the seller. Safe to say a worse offer in a 35-year relationship of trust, credibility, and building that relationship as a whole is going to win you a deal versus somebody who's known him for 3 years.
Well, that's how it works. A much smaller example. It's the same exact thing that we used in the beginning of this, the property management company I sold. I had built value in a company that I really loved. It did well. I wanted to move to Texas. I didn't want to manage in Washington State while living in Texas.
Doesn't make sense.
I lowered my price to sell it to the right person. I had multiple people who wanted to pay me more money. One of them was willing to pay me upfront. I could have just sold the company. I made the decision. I care more about the employees there, the long-term success of the company, and the fact that it's managing some of our rentals. I wanted to put the right person in the driver's seat.
Absolutely.
And I took a haircut to do that. It happens on, like you said, 500 unit deals. It happens on a 300 unit property management company, a little property management company in Washington State. Those deals don't trade to the best offer. They trade to the best relationship, which is exactly what you need to do.
That's how you win the game. At the end of the day, it's like you might present this offer that's incredible. Like people talk about outbidding all these big things, outbid BlackRock, yada, yada, yada. When you're buying real estate, the relationship always wins, no matter the case. Business, same thing. Relationships are supreme above everything else.
I hope you enjoyed this video and you got everything that you came here for. That's the goal of every single video. So we don't want to bury the lead. I don't want to have you go like, oh, wow, you must come to my next event. This is something I want to provide as much value as possible. If you haven't yet, please like and subscribe to the channel. It helps us immensely grow. Share this with a friend if they don't know how to find these terms. Share this with your community. It helps me grow the channel. More importantly, it helps me get more content like this out to you. We appreciate your time very much, and we will see you on the next episode.